I think the bottom line here is it will take time for property support measures to trickle down to the physical property market. And we still think the property developers are still deep in the woods, and high-yield property bond default will continue. I'm talking about this bailout fund. We think it might help prevent a mortgage boycott from spreading further and contain some of the systemic financial risk. But it is unlikely to immediately reinvigorate the housing demand, especially in those lower tier cities. And we also think the bailout fund are also unlikely to provide a full bailout of the unfinished home projects because of moral hazard concerns. So it's just overall, we don't believe the fund would boost the recovery rates or accelerate the restructuring process for holders of the defaulted property bonds. So I think this is a good policy direction, but we are not going to see this pulling the property developers out of the woods.
But do you think the restructuring process that you mentioned, the restructuring process that is apparently underway, I mean, do we have enough insight into that? Is there enough transparency and clarity? Do we know what the debt positions are of some of these companies?
Unfortunately, the clarity is not so great at the moment, but as we know, Evergrande is going to put out the preliminary debt restructuring plan by the end of the month, so hopefully we'll get more color from that. But in terms of the financials or the latest operating statistics, it has been very much in absence because some of them have not even reported the financials. I think this has been a quite big headwind on investor sentiment as well, and especially given a lot of the auditors have resigned from these property developers.
In the broader sense, how much of a problem do you see the global economic headwinds being, including the stronger dollar?
Yeah, I think this is going to be a major headwind for the Chinese economy in the second half of the year. We think this rising inflation and global central bank tightening is going to pose some downside risk to Chinese exports. And then, as you mentioned, for the dollar strength and higher bond yields in the developed markets could result in portfolio outflows from emerging markets, including China.
Okay, so tell us what your strategies are right now at CreditSights. I mean, how are you playing this situation?
Sure. So overall, we still recommend investors to stay very defensive with some moderate duration extension in IG space. For sector-wise, we like Chinese national oil companies, still quite high energy prices, and we recommend a duration extension in 5-10-year part of the curve for some yield pickup. Then we also like the large state-owned steel and aluminum companies, improving demand and curb supply in the second half of the year. And lastly, we see some value emerging among the A-rated China tech, the moderating regulatory crackdowns and decent yield pickups versus other A-rated Asian credits and U.S. tech peers.